Alright, so let's talk about something the mainstream financial news won't touch. Everyone sees the headlines about crypto millionaires buying Lamborghinis, but what they don't see is the sophisticated behind-the-scenes playbook that turns digital assets into incredible, tangible wealth. Multi-million-dollar villas in Dubai, multi-million-dollar villas in Bali. This isn't about just buying Bitcoin and hoping it goes to the moon. This is about a series of calculated strategic moves the biggest players in crypto use every single day to generate massive cash flow and quietly funnel those profits into hard assets. It's a world of private deals, complex yield strategies, tax optimization. Most people watch daily price charts of major coins, while the real wealth is being built in the shadows. Strategies let whales move millions without touching public exchanges, stack rewards from multiple projects, and leverage complex DeFi financial instruments. These aren't gambles. They're carefully constructed systems to maximize returns and manage risk, aimed at converting digital gains into a physical, luxury lifestyle. It's a completely different ballgame than what 99% of retail investors are playing. So, I'm going to pull back the curtain and break down the exact 10 strategies that make up this crypto villa playbook. We'll go step by step through each tactic. Private over-the-counter deals, discrete NFT flips. I'll explain how these methods work, what the risks are, and how they can generate the capital to buy your dream property. Ready to see how the top 1% of crypto investors make their money? Smash the like button for the algorithm, and let's get right into it. The first play, and honestly one of the biggest, is something you'll almost never see publicly: private over-the-counter, or OTC, deals. This is the secret handshake of crypto whales. Imagine you're a fund or an early investor who needs to sell, let's say, $50 million worth of a particular token. If you were to dump that on a public exchange like Coinbase or Binance, the price would absolutely tank. The sell pressure would trigger stop losses, cause panic, and you'd end up getting a terrible average price for your holdings. It's called slippage, and on a large order, it could cost you millions. So instead of selling on the open market, these big players go to an OTC desk. These specialized brokers connect large buyers and sellers directly. They agree on a fixed price, and the transaction happens privately. There's no impact on the public market charts, no panic, and no slippage. It's a clean, efficient way for the big fish to move massive amounts of capital without disturbing the water for everyone else. It's happening constantly behind the scenes for almost every major cryptocurrency. Here's a concrete example to make it real. Let's say a founder's tokens just unlocked. They want to diversify and enjoy life a little. They go to an OTC desk. I have 1 million tokens to sell. Current market is $20. I'm willing to sell at $19.50 in a single block trade. A fund accumulates without moving price. The deal closes. $19,500,000 hits the account, and the market doesn't even flinch. And this is where the playbook takes shape. That money isn't just sitting there, it's immediately put to work. A huge chunk is recycled into stable, income-producing assets. We're talking about real estate. Use it as a down payment portfolio or buy the luxury villa outright. Live in it, rent it, build generational wealth. Alright, the second strategy is a bit more active, but it's how savvy investors generate what is essentially free money, sometimes on a massive scale. This is the art of layering airdrops. A new project gives free tokens to early users to build community, decentralize ownership, and reward protocol interaction. Some have been worth tens of thousands, or even hundreds of thousands, like a massive, unexpected bonus. The advanced tactic is positioning across dozens of pre-token projects, bridge to new chains, swap on new DEX, lend and borrow, touch as many rumored protocols as possible. It's systematic. Use only risk capital, diversify so no failure wipes you out, and do due diligence on teams. You might spend a few hundred in gas across 20 protocols. 19 yield nothing. One winner pays 10, 50, even 100 times. Whales do this with significant capital, often multiple wallets, stacking several 5- or 6-figure airdrops a year. Add a 50K Uniswap drop, 20K from DYDX, and 10K from others. Suddenly, you have a $100,000 down payment. Next up, creating predictable income from your crypto. Crucial when saving for a house. Instead of locking everything for a year and being illiquid, build a ladder by staggering terms. 1, 3, 6, and 12 months. With $100,000, place $25,000 into each term, balancing higher APY from longer locks with short-term liquidity. As stakes mature, either take cash if needed or roll into new 12 months. Soon, something unlocks monthly or quarterly. If 1 month pays 5% and 12-month pays 12%, your blended yield moves closer to 12% over time while keeping access to principal. Skim the steady interest, convert to cash monthly, and build a dedicated Villa war chest. This can get wild on returns, and risk ramps up significantly. Provide token pairs to a DEX, receive LP tokens, earn trading fees plus reward tokens. Deposit LP as collateral, borrow more assets, create more LP, deposit again. Looping leveraged yield farming amplifies returns. Base 20% can approach 60% at 3x. That's how you see triple-digit APYs. But impermanent loss and liquidation risks are magnified. Manage it well, and yields can fund a luxury down payment shockingly fast. For insiders, early investors, advisors, team, seed and private sale tokens vest. Not all at once to avoid crashes. Pro move. Negotiate shorter cliff, faster vesting, or more unlocked at TGE before investing. If price is great but tokens are locked, sell rights to future unlocks via OTC or secondary markets at a discount to get cash now. 1 million vesting across 2 years sold for $600,000 today. You accelerate vesting, de-risk, and fund the villa. It's not what you make, it's what you keep. Favor crypto-friendly jurisdictions with low or zero capital gains. Establish residency. Set up compliant structures. This is legal tax avoidance, not evasion. A $2 million profit taxed at 40% leaves $1.2 million. Zero tax keeps 2 years. That $800K can be the villa difference. Borrow millions with no collateral if repaid in the same transaction. Capture tiny price spreads across DEX. Keep the difference. A few thousand per run, repeated at scale, becomes staggering. Fueling real estate buys. Bridge to chains offering higher incentives. Manage bridge risk. Consistently earn above static single chain returns.